Argentina's currency is in free fall. In just 3 days, the central bank torched $1.1 billion to defend the peso and still lost. At the same moment, China's households sit on $23 trillion in savings, almost equal to America's GDP. And Bloomberg says that money is avoiding U.S. Treasuries. Instead, it's flooding into gold, Chinese stocks, and swap lines with countries Washington can't control. And Trump's tariffs? They just pushed U.S. solar costs to 6 times higher than China's. This isn't just Argentina's crisis, it's another crack in the global system built on the dollar. Dollarization was supposed to end that panic. When Milei won in late 2023, he vowed to replace the peso entirely with US dollars. The promise resonated in a country scarred by inflation, where memories of 3,000% annual price increases in the 1980s still linger. But execution has been brutal. Argentina owes $45 billion to the IMF from the 2018 bailout and another $11 billion to private creditors, all denominated in dollars. Meeting those repayments forces the central bank to keep buying greenbacks while its stockpile shrinks. The IMF's July 2025 review confirmed nearly $1 billion in transfers in just 30 days. Inflation slowed from 150% at Milei's swearing in to 33% in August, based on official figures. Still devastating. Buying dollars means selling pesos. Each sale pushes the peso down further. Each drop makes debt service heavier. The loop tightens. To earn more dollars, Milei cut export taxes. Corn duties fell from 12 to 9.5%. Soybeans dropped by 1.5%. Beef tariffs eased too, the Financial Times reported in May. The idea was simple: boost export volumes. But the trade-off was lost fiscal revenue. At a moment when poverty still sits above 40%, that choice stripped the Treasury of badly needed income. The IMF's August assessment described the contradiction plainly. Export incentives create trade gains but reduce the state's dollar inflows. Investors saw this contradiction and fled. Argentine bond yields, once 5% above U.S. Treasuries, surged to a 15% premium, Bloomberg noted September 18th. Yet the higher yields didn't attract buyers. If the peso drops 30%, a 15% yield means nothing. It's a doom loop. Currency collapse cancels out the appeal of debt. China's $23 trillion savings pool now hangs over the global system. Bloomberg Economics in August 2025 calculated household deposits at that level, which is nearly equal to the GDP of the United States. Historically, such surpluses went into U.S. Treasuries. Not anymore. The IMF's July 2025 COFA report showed the dollar's share of global reserves slipping to 57%, while the renminbi climbed to 6.7%, its highest on record. China's holdings of treasuries have already fallen below $750 billion, compared to more than $1.1 trillion a decade ago. So where is the capital flowing? Well, partly into Chinese equities. The CSI 300 index rose 25% between April and August 2025, which is double the S&P 500's performance, Bloomberg confirmed. JP Morgan projected in July that $350 billion of household savings could enter local stocks this year. The surge reflects Beijing's deliberate policy to steer domestic wealth inward rather than lending it to Washington. Another destination is gold. Reuters reported on September 5th that China imported record volumes of non-monetary gold this year, while the People's Bank of China loosened import quotas. Since 2021, gold's price has climbed from $1,800 to over $3,500 an ounce, yet demand has not slowed. Analysts explain why. Chinese investors distrust fiat currencies, and gold serves as a hedge against both local deflation and global dollar debasement. For them, price is not a deterrent, but a signal. Already, Buenos Aires tapped a $5 billion currency swap line with Beijing in April 2025, according to the People's Bank of China. For Argentina, that injection rivaled IMF disbursements in speed and scale. It gave Milei a short-term cushion, but at the price of deepening dependence on China. The politics are no less volatile. Milei's party lost Buenos Aires province in August by 13 percentage points. Reuters reported August 26th it was a landslide against his austerity platform. Markets punished him instantly. The Merval index fell over 12% the next day. Milei conceded, "We suffered a setback and we must accept it responsibly." His weakened mandate raises doubts about whether he can keep slashing spending or pushing privatizations. A Bloomberg column asked bluntly, can Milei govern without public support, or will investors conclude Argentina always reverts to type? History gives investors little reason for faith. In 2018, the IMF's largest bailout in history collapsed within months. Christine Lagarde called it a model. The peso proved otherwise. The Wall Street Journal observed then, and again this year, that domestic reforms cannot offset global dollar tightening. When liquidity dries up, the weakest link breaks first. In 2018, it was Argentina. In 2025, the cycle looks eerily familiar. Then there is China's dominance. China controls 80% of global solar panel production, 60% of wind turbines, and 75% of EV batteries, Bloomberg NEF reported in August 2025. The costs really illustrate the gap here. Chinese solar modules average about 8 cents per watt. In the United States, before subsidies, they run close to 50 cents. Trump's tariffs just can't close that spread. They only make panels more expensive for American households while pushing buyers abroad toward Chinese supply. The International Energy Agency reported that U.S. solar installations fell 18% year-on-year in July, while Chinese exports of panels to Latin America and Africa surged 30%. Venture capitalists are seeing the same imbalance. In May 2025, U.S. investors toured Chinese EV and battery plants. The Financial Times quoted one bluntly, "When it comes to battery manufacturing in the West, China's dominance means it is game over." Several funds halted financing for Western startups afterward, preferring joint ventures with Chinese firms. The supply chain kind of explains why. Lithium, cobalt, and nickel may be mined in Chile, Indonesia, and Congo, but most refining actually happens inside China. That vertical integration really slashes transport costs and guarantees inputs for domestic industries. An FT analysis in August concluded, decoupling in energy technology is not economically rational. The EU might talk about breaking free, but the economics just don't add up. Trump's rhetoric of energy independence faces the same bind. Without subsidies, American panels remain 5 to 6 times more expensive. With subsidies, taxpayers end up footing the bill. Either way, the United States loses competitiveness while China scales up exports. The risk is that tariffs could accelerate the very dependence they were meant to erase. While Argentina burns reserves and China pivots its savings, another front in this financial fracture is Europe. In June 2025, the European Commission raised tariffs of up to 38% on Chinese electric vehicles, Reuters reported, arguing unfair subsidies distorted markets. Beijing retaliated by suspending imports of European pork, a trade worth $2.5 billion annually according to the USDA. The escalation really demonstrated that dollar scarcity is not the only shock food. Metals and vehicles are now bargaining chips in a widening tariff war. For commodity producers, the consequences are immediate. Bloomberg noted on August 22nd that copper prices spiked 14% in a single month, driven by China stockpiling supplies ahead of new trade barriers. The surge pushed costs higher for manufacturers from Germany to South Korea. Meanwhile, the IMF's September commodity outlook warned that emerging economies dependent on copper, lithium, and nickel exports face, heightened volatility as demand is rerouted through Chinese supply chains. And beneath these battles lies a quieter shift. Swift transaction data published in August showed that the renminbi overtook the euro for the very first time as the world's second most used trade currency, handling 5.3% of global payments. The dollar still dominates at 57%, but the symbolic move really underscores a trajectory. The tools once thought permanent, IMF rescues, US tariffs, European alliances, no longer guarantee stability, which raises a deeper question. If one middle-income nation like Argentina can trigger market panic with a $1 billion reserve drain, what happens when the pressure reaches economies 10 or 20 times larger? All of this circles back to Argentina. Milei bet that adopting the dollar would anchor confidence. Instead, Argentina is learning the hard truth. When global liquidity contracts, dollars are scarce even for those who tie themselves to Washington. When Beijing holds $23 trillion in savings and chooses to channel it into gold, local equities, and bilateral projects instead of United States debt, the burden on dollar-dependent states grows heavier. When Trump's tariffs inflate costs at home while entrenching China's dominance abroad, the argument for dollarization in peripheral economies becomes harder to defend. Argentina becomes the case study. A president who staked his future on radical dollarization now faces collapsing reserves, hostile markets, and crumbling domestic support. China steps in with swap lines and investment, but not in dollars. The United States retreats into tariffs, but gains no competitiveness. The peso slide, China's $23 trillion pivot, and America's energy losses are not separate stories. They are the same story told in different currencies. Argentina's peso crisis is not just a local failure of dollarization. It is evidence of a system where the dollar dollar itself, once seen as immovable, is becoming a liability. And if Argentina is the first to fall, how many others tied to Washington's currency are waiting in line? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.